Well, Richard Galvin is Executive Chairman and CIO at DACM, or Digital Asset Capital Management. It's an institutional investor which invests across the digital asset sector, from early stage venture partnerships to listed and derivative markets, and has been recognised as having some of the top performing funds of their categories. Richard, welcome.
Thanks for having me.
How would you describe your investment philosophy?
We take a view that we're going through a digital age and we're going a digital revolution, and we have been probably since the early 80s, and this will continue for some decades to come. And we've seen incredible technological change through that, and I'm old enough to have to live through some of the first wave of that around the internet disruption and what that happened. And there's clearly a lot of things still to be disrupted as we move into more of a digital existence, and crypto's kind of leading the frontier of that. So we feel as if we're on the sort of cutting edge of the next wave of digital disruption through this digital revolution we're going through, and people trying to reinvent the whole way we do things, like the way we exchange money, the way we transfer media content, the way we pay and reward each other. All those sorts of things are getting remade using what is basically highly disruptive technology that can lower costs and give people more ownership of the things they do in everyday life.
And I see you say that the thing you like perhaps most about the cryptocurrency space is its inefficiency. Why is that?
I think the space drives a lot of efficiencies into new areas, but I think the market is inefficient in the way that it values it. And we've been successful at finding assets that we think have been misunderstood, forgotten, or grossly mispriced, acquiring those assets within our funds and waiting for the market, in our view, to get it right. And we think that if you looked across asset classes, over the last 30 or 40 years, you have seen incredible efficiencies come in as liquidity increases, as the digital distribution of research becomes broader and broader, and you've seen the margin for managers like us to make less alpha effectively get eaten away, and people go into ETFs and index funds as a representation of that. Crypto's like stepping back into the past, where you've got a lot of new frontier tech that's poorly understood by most investors, poorly researched, particularly at an institutional level. And so we find it's one of the asset classes where you really get reward for the hard work you do. So if you make a call in crypto and you get it right, you get big returns.
How many assets do you keep your eye on? Have you got a watching brief on?
Yeah, so we probably 100 or so we have a watching file on. We generally hold in size around 15 in our liquid fund. We have a team of 18 people. Around 11 of those are on the research side. So we have people sort of scouring the earth, looking for new ideas, doing the analysis on the assets we hold and the ones that we might add to the portfolio.
Can you give us a sense of your top holdings at the moment?
Yeah, so our biggest hold, we actually own more Bitcoin than we've held since 2019 at the moment. We just think the tailwinds to Bitcoin are great. We own a lot of Solana, and we have since 2020, and we've stuck with that sort of through thick and thin. We own a substantial amount of what I'd call applications. So in the crypto space, you can broadly cut it into two spheres. You have the protocols, the things like Ethereum, the things like Solana. They're effectively, you think of them, the engines that actually applications are built on top of, and then the applications. It's about 95% of the crypto space's value is made up of those protocols, and only about 5% is made up of apps. We own close to half of our fund into apps. We just think they're compelling value and mispriced in the market at the moment.
Let me read a quote to you from you,
oh, wow.
where you said, there's a lot of FOMO, but on the other side, there's still a lot of nervousness around the volatility and regulation in the space. You said that 3 years ago. So much has changed, or has it?
No, so much has changed, and for the better, thankfully. So I think, having travelled the world talking to sophisticated investors about crypto since we launched the firm in 2017, there's been a number of sort of key issues that have stopped those investors from investing, and a bunch of which I understand. So the first one really that used to always get sort of brought up to us was around Tether, the biggest stable coin in the market, its lack of effectively clarity between its asset reserves and its ability to collapse and bring down a chunk of the trading space with it. We think that's largely taken off the table now. Tether's externally audited. It discloses its reserves. It keeps its reserves with a regulated custodian in the US. That's now gone. The second one was around is there any value to these tokens? We own tokens that make hundreds of millions of dollars a year at the back end and distribute that to token holders. Tether itself, I think, is the second or third most profitable financial company in the world now. So the concept that crypto is all just a trading of assets that have no utility, I think, is well and truly dead now, just given the quantum of money and revenues that are starting to flow through the system. The third one is regulation. How do I invest in an asset class that has no regulatory certainty or runway? And I think particularly with the election of Donald Trump, that's now off the table as well. So we think the three kind of key kind of like road bump issues that have stopped a lot of investors have now all fallen away over the last 3 years in our favour, thankfully.
Richard, thanks very much. All right, well, so as you can see, the opportunity set in crypto is diverse and not one size fits all. So let's throw it open to the panel now. And Mark Carnegie there at the top referred to crypto as the forever asset class. Is it, Richard?
I think it is. I mean, even in a weird way, the digital assets that we have, if you look at it both positively and negatively, when you create a decentralised asset, it's not reliant on any one person or any one balance sheet or any one thing to keep it going. So even if it stops getting used, to take the negative view, it still exists because it can't effectively not exist. It can't be taken away. No one can shut it down. No one can stop it. It may have very small to no value, but it still exists. On the upside, we are at a very early stage in what we think the disruption of this asset class and the technology that it's bringing to the world is doing. So we see multiple decades ahead of us as crypto grows into all the sorts of use cases we think it will over the next 20 to 30 years.